closing weaker on Wednesday, with global peers mixed as investors took stocks, or should I say took stock of markets' strong rebound on Monday and Tuesday. Now, the JSE all-share losing 1.06% today. The local index will be contending with mixed global markets. Makwe Masilela is Chief Investment Officer at Makwe Fund Managers, joining us now for the latest updates on the market trends. And Dada Masilela, good morning to you. Your quick overview of how the JSE is tracking in early trade.
Morning, Tolu, to you. Definitely, the JSE managed to open up nicely, reversing all of yesterday's losses. We opened up 1% because on the expectations that there will be some economic recovery in China. We know China is on holiday, but apparently the guys are spending during this week. And also expectations that there will be demand increase when it comes to the commodities. And then that is going to definitely help the world economies. So we are only trading up based on all those kind of expectations.
Let's talk commodities. OPEC Plus producers have agreed to cut output by 2 million barrels per day. We're talking oil here, the biggest output cut since the start of the pandemic. What does it mean, though, for oil production moving forward and fuel prices in the near future?
You know, for the producers, it means more money because they're doing all this so that they can get oil prices to go up. But for consumers, as oil prices continue to go up, then unfortunately it's going to have a strain on our finances, on the economy, and most probably inflation will go up. And as inflation continues to go up, then the Reserve Bank or central banks of this world, they will definitely continue to increase interest rates. And it's happening at the time when people have been pleading with them that please can you pump more, and also happening at the time just ahead of the Russian oil embargo by the European Union. So it's not a good picture for other countries who are consumers of oil.
Well, let's talk about the one country where you and I live in, that's South Africa, submitting some of the world's richest nations, submitting to these nations a revised plan for how we are going to spend the over 150 billion rand to help transition away from coal. What do we know about this proposal?
Not much, but what we know is that you owe it to your donors to explain how you're going to be spending their money that they'll be giving to you. But the whole idea here is all to make sure that you also comply and make sure that you meet your targets when it comes to climate change. And the question here should be, why should we be worried about meeting those targets that were set when things were still okay? Why can't those targets be revised? We've seen that ever since we had the COVID-19 pandemic, we had the Russian-Ukraine issue, that changed the complexion of almost everything. So also when it comes to those kind of targets, nothing should be stopping us to revise them. But as it is, we know that even major economies themselves, they went back to start using coal, given that there's been very serious shortage when it comes to energy, especially the likes of gas.
Let's conclude with data from the National Credit Regulator, which shows that consumer demand for credit remained strong in the second quarter, while the debtors book shows no big sign of deterioration in terms of people being in arrears. Help us make sense of this data.
I think this is very temporary. Yes, we've seen a slight decline when it comes to the access of credit. But we need to be mindful that if you look at the mortgage credit that has been given, we've seen a nice increase. And it makes sense that we've seen that there have been this semi-migration, people moving to the coast. And we've seen that the coastal municipalities had more plans approved. But when you look at secured credit, here we are talking mainly we are motor vehicle finance. It only makes sense to see a decline because people are not too certain about their future. So what should they be forced to change their vehicles, especially if they're still in good condition? And you look at the credit facility, there's been a decline as well, because we know that kind of facility happens to be quite expensive. But as much as it is expensive, we know that most consumers, some of their salaries cannot last them for the month. Hence, we see an uptick when it comes to unsecured loans, even though those unsecured loans continue to be expensive, but it's easy to get them. And worrisome to see that almost 62% of the credit active consumers are the ones who are only in good standing. the rest is not looking okay. But if you look at what we call the consumer credit index in the second quarter, we've seen a big fall, from 55 to 49, and that itself is a good indication that looks at the health of the credit of the consumers and tells you that the ability of the consumers to be able to service the current debt. Even our July civil summons jumped, from June to almost just over 13%. So things are not looking okay going forward. Hence, I'm saying that temporary.
Makwe Masilela, Chief Investment Officer at Makwe Fund Managers. Thanks indeed for that markets update.